studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
The excluded shares test is another important exception within the TOSI regime. But unlike the excluded business test, it focuses primarily on ownership rather than active participation. In the excluded business test, the key question is whether the shareholder is actively involved in the operations of the business. With the excluded shares test, the focus shifts to the shares themselves and the corporation that issued those shares. The basic idea is that certain shareholders who own qualifying shares of a qualifying corporation may be able to receive dividends without being subject to TOSI. This exception recognizes that ownership can represent a genuine economic interest in a business, even when the shareholder is not heavily involved in day-to-day operations. However, simply owning shares is not enough. The legislation contains a number of specific conditions that must be satisfied before the shares can qualify as excluded shares. These conditions relate to factors such as ownership percentages, the nature of the corporation's activities, and the relationship between the corporation and other businesses. The important point at this stage is not to memorize the technical requirements. Instead, focus on understanding the overall structure of the exception. The process generally begins with a shareholder who owns shares in a corporation and receives dividends. The next step is determining whether those shares meet the legislative requirements for excluded shares. If the conditions are satisfied, the excluded shares test may be met, and TOSI may not apply to the dividends received. Notice that this exception is fundamentally different from the active involvement tests we discussed earlier. A person may qualify under the excluded shares test because of the ownership structure and characteristics of the corporation, even if they do not qualify under the excluded business test. That is why this exception can be particularly valuable in situations where ownership is significant but active participation is limited. The key takeaway from this slide is that the excluded shares test provides a potential pathway out of TOSI based on qualifying share ownership, rather than focusing on the amount of work performed. The analysis focuses on whether the shareholder owns qualifying shares in a corporation that satisfies the required legislative conditions. The excluded shares test may appear simple on the surface, but it is actually built on several important legislative requirements. To qualify for this exception, a shareholder generally needs to satisfy multiple conditions at the same time. The first major condition relates to ownership. The shareholder must have a meaningful ownership interest in the corporation. In broad terms, the legislation looks for significant voting rights and a meaningful economic stake in the company. This requirement is intended to ensure that the shareholder has a genuine ownership interest rather than a minor or purely nominal position. The second condition focuses on the nature of the business itself. The excluded shares test is generally designed for corporations that earn most of their income from active business activities rather than from providing services. Manufacturing businesses, retail operations, construction companies, wholesalers, distributors, and equipment rental businesses are examples of the types of corporations that may be more likely to meet this requirement. The underlying objective is to distinguish between operating businesses and corporations whose activities are primarily service-based. The third major condition involves related corporations and related business income. The legislation contains rules that limit the availability of the exception when significant income is earned from certain related corporations or affiliated business structures. These rules are designed to prevent arrangements that could otherwise be used to shift income within a related group of companies. One important point to remember is that these requirements generally work together. Meeting only one condition is not enough. A shareholder may have significant ownership, but if the corporation fails the business requirement, the exception may not be available. Likewise, a corporation may operate an active business, but ownership requirements must still be satisfied. This is why practitioners often review the excluded shares test using a structured checklist. Each requirement must be evaluated individually before a conclusion can be reached. At this stage, it is not necessary to memorize every technical detail. The important takeaway is understanding the overall framework. The excluded shares test is based on a combination of ownership requirements, business activity requirements, and related corporation rules. When all of these major conditions are satisfied, the shareholder may qualify for the excluded shares exception, allowing dividends to potentially avoid the TOSI regime and receive normal dividend tax treatment. One of the most practical ways to understand the excluded shares test is to look at the types of businesses that commonly qualify and the types that often encounter difficulties. Remember that one of the key requirements of the excluded shares test is that the corporation generally cannot be primarily a service business. Because of this requirement, the nature of the corporation's activities becomes extremely important. On the left side of the slide, we see examples of businesses that are often more likely to satisfy the test. These include manufacturing companies, retail businesses, construction companies, distribution and wholesale operations, and equipment rental businesses. These businesses typically generate income from producing goods, selling products, operating facilities, renting equipment, or carrying out active commercial activities. Because their income is generally not derived primarily from providing professional services, they may be better positioned to satisfy the business requirements of the excluded shares test. Of course, qualifying ownership and the other legislative requirements must still be met, but these types of corporations are often the ones practitioners examine when considering this exception. On the right side, we see examples of businesses that frequently face challenges: accounting firms, law firms, consulting practices, medical practices, and other professional service corporations often derive most of their income from the personal services provided by professionals within the business. Because service income plays such a significant role in these corporations, they may have difficulty satisfying one of the key requirements necessary for the excluded shares exception. This does not automatically mean that every service corporation fails the test. Each situation must be reviewed based on its specific facts. However, service-based corporations often require much closer analysis and are generally more likely to encounter obstacles when attempting to qualify. That is why experienced practitioners often begin their review by asking a simple question: is this primarily a service business? The answer to that question can provide an early indication of whether the excluded shares test is likely to be a viable planning opportunity. The key takeaway from this slide is that the excluded shares test is generally most valuable for non-service corporations. Businesses involved in manufacturing, retail, construction, distribution, and similar operating activities are often stronger candidates, while service corporations commonly face greater challenges in meeting the requirements of the exception.